area here in Philadelphia. So today we're going to talk about the college affordability and year-end college planning strategies. A big thing that many people don't realize is that the tax years and school years don't match up, and we're going to talk about that in length, that you really have to plan in advance as you go through this process. It's probably one of the most expensive things you'll do as a parent, and probably one of the most complicated financial decisions you'll make in your lifetime when you really go through and look at it. We're going to try to touch some of those areas for you tonight. I can just, a little background on myself. I am a parent of 3 daughters. My youngest just graduated last year. All 3 got out in 4 years. 2 of them changed majors. 2 of them changed schools. 1 was a student athlete, and all graduated and got the jobs that they wanted. So I've been pretty blessed that way. So I've lived this nightmare that many of you are facing now. So what we're going to do is go through the college planning environment, things that you need to know about. Wanted to make sure that you understand the financial aid process. So that's a big part of knowing what's going on. And everyone gets really focused on this EFC, or the financial aid positioning. And there's so much more that you can, so many more strategies you can use to save yourself money. The last thing really is we're going to also talk about strategies by school year. So we're going to go through the 2 or 3 school years, depending on where your child is in this process. And then want to review what you should be looking for, what should be part of your plan, how that all works, and things that you should be considering. And then we'll wrap it up with some summaries and some questions, hopefully. Just wanted to footnote, this is for the lawyers in the audience. I am a financial planner. We're fee only. We don't sell any financial products. I'm registered in Pennsylvania. So I just wanted to throw that out there, make sure everyone's aware of that. We're not going to talk about investments, but in case we do, it will be important. Just a little background about myself. I'm a fee-only financial planner with an expertise in the entire process. So we go from how to save for college all the way to how student loan forgiveness works and anything in between that. And then what's unique about me is that I also bring in the personal financial expertise. So how does taxes or retirement planning impact this financial decision you're ready to make or investment in your child? As a point of reference, I have presented and I write for IECA, which is the Independent Education Counselors Association. There's 2 large groups. One is IECA and the other one is HECA. So they're the 2 major ones that have college planners. They're the ones that help you with your SATs and your positioning and writing what schools you're going to go to and all that kind of stuff. We just focus on the financial side. That's our expertise. So we are a presenter there at their summer program, and also I write to their bi-monthly program on college affordability. We're the first financial planning firm approved by HECA. Both of these are international firms or international organizations. I'm a board member for the National College Advocacy Group. That's a nonprofit that focuses on both the academic and financial side, and I've been a board member for that for 3 years. I'm also a NAFTA member, so we're the fee-only organization, financial planners. I'm a member of that, and I've also presented to that organization in different things. I have my MBA, and I'm also a chartered financial consultant. So let's get into the program. So this is, again, as I said, one of the most complicated things you'll do, and you really need to look at it as an investment in your child, and your child also has to recognize that this is an investment in themselves and in their future, and not just something that we need to do. So what we're seeing now, as I go through this, my oldest one is a perfect example. Careers require more education, which is kind of harder for the students right now. It's very different than it was when I went to school, and where you just went to school, you got a degree, and you got a job. That's not the world that our children are growing into, and as parents, we need to be smarter and help them along this process much more than probably many of our parents helped us from a just knowledge base and environment standpoint. So more and more careers are requiring postgraduate degrees. So my oldest is a speech pathologist. She needed her master's to get her job. So as a parent, you need to understand what you're going to be able to afford and have some vision of what they're going to look like at 25. And how much education are they going to need to get to the job they want? Does it need a master's? So speech pathology, physical therapy. Are they going to law school or medical school? A weird one that you won't even think about is accounting. My youngest graduated last year with accounting and finance degree. Well, to sit for the CPA exam in Pennsylvania, you need 150 college credits now. So, and you usually graduate with 120 to 130. So these are the things that are happening where more education is required and it's much more expensive. Another thing we're starting to see, and we try to get our clients to focus on this, is on the outcome of the education. Why are we going to school? How much debt are you going to have at graduation? Are you going to get a job? Is that job, what's that job going to pay? What's the education requirements? All that needs to be discussed as part of your decision process. And at least in my view, you need to have that decided by the end of their freshman year. It's okay if they don't know, but I think it's very important that they have a good direction by the end of the freshman year. And that freshman year should be a time where they do some investigation work. Business Career Center is an important part of the process for me as you go through this and understand services the Career Centers offer and also what internship programs they have. So that's an important part is this new world that I think we're living in. Parents are becoming more concerned about cost and debt. We're seeing all these debt numbers out there. Student debt is, depending on where you read, it's anywhere from $1 trillion up to now 1.2 I've seen, as high as that number. So it's getting more and more complicated and also more expensive. The biggest changes that are starting to happen for the schools and for the verification process is now the IRS system and the FAFSA system are linked. So the verification process, they'll be able to see a lot more. There's been a few situations last year that people got caught into. You need to be aware of that. They're also going to be looking at non-traditional families. This would be gay and lesbian parents, non-married parents that are living on the same roof, separated parents that are still using the same addresses. They will be looking into all these things to look at combined incomes. So just be aware of these changes. When we go through this process, if you're in a divorce or separated situation, we typically, we recommend that whoever's submitting the FAFSA form, that child should be on their tax return. And that's not always the best tax advice, but from a financial aid standpoint, it eliminates a lot of issues. Some myths that are out there. One, take all the assets out of your child's name. No, that's not true. You really have to understand your financial aid positioning and how your EFC number comes together. And we'll talk about that in a few minutes. But if you're not going to qualify for need-based aid, actually you want to put assets in your child's name because of the tax reason. So that is not true. And we'll talk about why it's not true in a few minutes. Having less assets in my name, I'm going to qualify for more aid. That is somewhat true, but what you need to realize is this is business. A college education is big business. As you've probably seen, the number of brochures, the quality of the brochures that you get, it is very, very expensive. And now the schools are really starting to look at your ability to pay. So not being able to pay may actually hurt you from an admission standpoint. So there's this new, it's not relatively new, but a new way to look at this is that the application process or the admission process is filling in a quilt, as they would say, and then what that quilt will generate in revenue is the next part of that, and that's what's called the enrollment management department of the colleges are looking at. So they want to pick the kids they want, but then if we swap out a few kids here and there, what's that revenue stream going to give for us to run the college? So again, it's business, and you need to realize that. 529 plans are only pre-college tools. Not true. Especially if you're a Pennsylvania resident or a resident where there's tax incentives with the plans, they're really a great tool to use while the students are in college. We actually have our clients prepay their tuitions from a cash flow standpoint into the plans each year. And as I said, the tax years and school years don't match up. So if you're a junior parent, you have until 12/31 to really look at your numbers. On our website, on the College Affordability website, there's a free EFC calculators out there. And you can work through those numbers and find out where you're going to fall out for financial aid. So the tax years and school years don't match up. Think of it this way. The seniors that will be applying for financial aid this year were second semester juniors, first semester seniors, and that's the tax year that will be used for their first financial aid package in September of 14. So that's the way you need to look at it. It's almost a year and a half in advance is the way you need to look at that. So creating your financial plan, your college financial plan, one, you have to understand the different parts of the EFC number and how other things interact. So contributions to your 401k at work or your 403b at work, contributions to an IRA, if I'm an executive deferred compensation, if I should sell stocks, what's that going to do to my taxes? All those things have interaction things that could impact your EFC number. Creating a family timeline. So it's an important part for two reasons when we look at this, and we do this for all of our clients, is one, are there years where there's overlap of children, multiple children in school at the same time that's going to help you with your financial aid positioning? How much, if you've had children in life, when's the last one get done, and how much time do I have to recover for retirement, and what's my retirement planning look like? So both of those are important parts and why we do a timeline for our clients. Having a good mix of college options. And when we do a plan, especially for like the junior parents and below, you have to look at the value proposition two ways. One, what's it going to cost me to go there? What's my out-of-pocket cost? And how does my financial aid position change? So, we'll do, 1 or 2 a year where we'll have clients where, they can go to that higher end school. The ticket price may be substantially higher, but because of the way their financial aid position is going to change, the number of kids that will be in school at the same time, they may qualify for aid down the road that could be substantial, and that school may meet a high percent of that number. So when you look at it over a 4-year period, maybe they go to a really top-notch school for $30,000 or $40,000 more than it would be to go to a Penn State or Pitt, because they're not going to qualify for aid, especially for the middle income, upper middle. Just don't look at the lowest cost. You have to see how the financial game is going to get played. I think is an important part. This is often overlooked. You have to really look at this as a 4-year cash flow analysis, and that's what we actually do for our clients. And the sad part about it also is that the national graduation rate, if you go into a 4-year program, is less than 40%. So it actually should be closer to 5, but you just need to realize that this is a big financial commitment. And then what are the financing decisions beyond financial aid? So how, if I'm going to retire at what time and what's that look like? How should I borrow the money? What's going to be your commitment to your child, and who's going to take on what debt? And if you are going to take on the debt, a lot of it will need to be in your name, at least initially, and that's really the scary part, because this type of debt is not forgiven through bankruptcy or anything like that. So that is a thing you just need to be aware of as you go through the process. So here's the EFC calculation, and what this stands for is the expected family contribution, and this number is generated once you complete the financial aid forms. And there's two major types of forms. There's the federal methodology, which is called the FAFSA form. That becomes available every January 1st. So senior parents, if you're ready to do this, you need to look at that. Again, I'd probably wait until the first week in January. There's always a few bugs that there's issues. There's rumors that go out there that says, oh, the earlier you get into the more aid you're going to get. That's not true. So again, you need to have your PIN numbers, which you'll need one for the child, one for yourself, who's ever going to electronically sign for that, and then you fill out the forms. Everyone thinks it's just one number. It's actually 4 separate calculations. So it's parents' income, parents' assets, child's income, child's assets. All 4 of those quadrants get added together, creating your EFC number, or your expected family contribution. As I said, there's a free calculator on our website that you can go and look at, and that's another thing too. Be really careful about your resources. There's a lot of free information or calculators out there. A lot of them are run by either banks or financial institutions. When you go through this process and fill out this information, you disclose your entire financial life. So you have to show them what income you have. We had a school that I speak at a few years ago. The guidance counselor called me and said, "Hey Fred, can you check out this website?" It was a marvelous website, and we got to the end of the website, and there was 8 banks there. Well, when you filled out all the information, you gave them your name, your address, how much money you made, how much money you have in the bank, and now they had all your financial information. So just be very, very careful as you go through this process. And an important part too on this EFC calculation, we break it up into the 4 quadrants. When you see the parent's income side, we talked about taking assets out of the child's name. Why people say that is that in the child's asset side, the assets are weighted 20% of the value, okay? On the parent side, there's an allowance based on the age of the oldest parent, and those assets are only weighted 5.7%, 5.6%. So that's why everyone makes that statement. But as an example, we'll see this in a few minutes, if the parent side of the equation gets added up and say that ends up being $35,000, and my child's going to be going to Penn State or Westchester, and that cost of attendance is $30,000, I'm not going to qualify for any need-based aid, so moving assets out of the child's name is going to be immaterial, have no impact on your numbers or your positioning. So again, knowing your numbers, knowing your schools is kind of important. So I said there are two methodologies. There's the federal methodology, which every school uses. That's the FAFSA form. Then there's the institutional methodology, and the most common is called the CSS profile. Some schools have their own methodology, and it is their own interpretation of the information. So some schools will include home equity, a portion of it. Some will include none of it. So let's go back and first look at the federal methodology. As I said, it's 4 quadrants. Then the things that will impact your number will be the number of students in college at the same time. That's what important. Your family size, age of the oldest parent, the type of assets, tax filing status, married and separate, or all that kind of stuff, and the family structure. So all those things will impact how your number comes together. So let me give you the 3 major issues that you have with the type of assets on the federal methodology. They're often misunderstood. Retirement accounts, not included on the federal side. Home equity, not included. And if you're a small family business owner, it has to be a family business with less than 100 employees, that asset is not included. The one exception to that rule is if you are a real estate person. So if you own real estate, as an example, apartment buildings or different homes, and that's how you make your living, that's the one exception. And I don't know why the government doesn't fix it, but that's the one exception they give you. So it's kind of unfair. Example, if you have a business owner that has property and the property and business are worth $3 million, and you have a person that owns 1 or 2 apartment buildings and that's worth $3 million, and both were family businesses, the manufacturing person, $3 million would not be included, where the real estate person, it would. So it's just the way the game gets played, and they're the rules. You just need to be aware of it. As I said, every school will use the federal methodology. On the other side, you have the institutional methodology, and everything's in play there. So they'll ask assets in other children's names, other tuitions that you may be paying, which is a benefit. Things like that. It doesn't matter what type of business you have, they're going to look at whatever that structure is. So again, you have to know the rules, and only about 300 to 400 schools and some private scholarships use that methodology, that CSS profile. And if your child's going to do early decision, that will be required also. So they're the type of things you need to just be aware of as far as the process goes. So here we go, as how's the game get played. So costs of attendance, so tuition, room, board, books, fees, things like that, minus the EFC number, which was generated from completing the financial aid forms, equals what you qualify for need. So this is the need-based side. Just to take a step back, the merit side, you want to apply to a few schools where your child's going to be the upper tier, which will help you qualify for the merit-based aid. So if you know you're not going to qualify for need-based aid, where your child is, has that academic strength, this is, schools that you should have on your list just as a financial decision. Once you have your need or the numbers determined, then the school will meet a % of that need. And within that %, the school then have so much will be free money and so much will be self-help, which is work, study, and loans. So understanding how that all gets played out is dependent on the schools. So an example would be your state schools are going to meet less of the need, and less of it will be self-help, versus a private institution will meet typically more of the need, and more of it will be free money because they have a higher endowment and things like that. So that's an important part to realize. And only about 1 to 2% of the schools will meet 100% of needs. So again, they're your Ivies and your more competitive schools meet that higher % of need. So if you have the academic ability to get into those schools and you have need, you can go to those go to those higher price schools for the same price or even cheaper than you would, say, a state school. So don't be afraid to apply to those higher end schools. So here's put some numbers in what we're talking about here. Numbers at 8 o'clock or 8:20 in the evening is a little bit tough. But so just for this formula we just talked about, we have 2 schools we're looking at. One's a $20,000 school, one's a $40,000 school. We've completed the FAFSA form, and with that FAFSA form, we've gotten an EFC number of $25,000. So again, we did the calculation, we manipulated as best we could, or positioned ourselves the best way we could, and it came out to be $25,000. So in school 1, we said cost of attendance less your EFC, it comes to 0. Now, because we completed the financial aid forms, the federal government will allow us to take the Stafford loan and we're not going to go into a lot of detail, but you will qualify for the Stafford loan. It will be unsubsidized, which means the interest will be charged to that loan at this year it's 3.86 while you're in school. Okay, where in school 2, we're looking at a $40,000 school. First thing you have to realize is that the $25,000 is the same at both schools, which will be the same. If we looked at 10 schools, the 25 from the federal methodology will be the same. Okay, we have need of 15. Now the school's going to come back with a package of 12. So we have a $3,000 gap. This is the first part. Within that $12,000, there'll be $2,000 of an unsubsidized loan, $3,500 of a subsidized Stafford loan, probably some work study, and the balance will be maybe in free state money or something like that. So again, here's where understanding how the game gets played is an important part. This is probably one of the most important slides we have tonight, understanding how the game gets played and how your EFC number gets put into the process of where you apply to school, what that school meets of need, and all that stuff. That's what we have in our database to help parents understand what their true out-of-pocket is going to be when they apply to school. Again, the schools will only give you a vision of this at 1 year at a time, and this is where, as an example, maybe you have a second child coming in a year or two, and now that 25 gets cut in half. So in school 1, you may qualify for aid depending on how that EFC number changes and when that second child comes in. So this is, again, why it's important to do that for your cash flow as you go through the process. As you go through the process, there's kind of 4 categories that we consider families as you go through this. So 1, you have a low EFC. You're going to get aid no matter what school you go to. Then you have the middle income or middle EFC, where as that example we just saw, where you have the $20,000 school and the $40,000 school, you may qualify for aid at some schools. You may not qualify for need-based aid at other schools, and so that's the middle people. Then you have the changing people, where you have, depending on your family structure, when your children are going to be going to school, all those things, where initially you may not qualify for aid, and then in a later year you may qualify for aid. Okay, and then the third one is, the fourth one is, I have a high EFC number. It's not going to get any better because either my children, I only have 1 child, or only one in school at the same time, and I'm not going to qualify for aid no matter what school I look at. So all of those are the 4 major categories that you can fall into as you go through the process, and there's strategies to lower your out-of-pocket costs in each one of those. So it's an important part to realize that what the schools say you have to do outside of the financial aid process, and we're going to talk about some of those that can lower your out-of-pocket costs in other ways, not just the financial aid system. So as I said, and I've said this a few times, is the importance of a 4-year program. 1, you can see what the outcome looks like. So what's your debt level going to be? Whose debt it's going to be at graduation? That's an important part, and how you finance that. The impact of other children changing. If you have multiple children coming online, how your EFC number changes, and what year does it change in. So maybe this is your second child going in, and they get into a high-end school, and their award may look very attractive, but maybe their older brother or sister is going to be graduating next year. You may see a substantial increase because next year your EFC number is going to go up because now you only have 1 in school. So again, knowing where you are is very, very important. Identifying the personal budget stress. So this is, when we do a plan for clients, we ask them how much money they have earmarked for education, how much they give per year, and it shows them the additional resources they're going to need to come up with over those 4 years. So some of it they may have, some of it they may have to borrow. What are your lending options? All those type of things need to be considered, especially in this process, because a lot of the debt will be in the parent's name, because the children are often limited on what they can take on, or at a minimum the parents will have to co-sign, which you need to just be aware of. As you do this 4-year cash flow, you can see what your total out-of-pocket is going to be. So again, as we said in the very beginning, more and more education is required for a lot of the careers. What do they look like at 25? Are they doing what they want to do? Did they have to take on a lot of debt to go to graduate school? What's that job pay? What's the quality of life? So as I have 3 daughters, my middle one is a math teacher, and she's extremely analytical and bright, and was one of the questions we had with her, deciding what she was going to do. A lot of people were asking her to be a computer programmer because of her analytical abilities, and she said, I want to be a teacher because if I have to work while I'm in school, or when I have a family, I'll have off during the summers, and I'll be home in the afternoon. So again, there's discussions of quality of life that's an important part of this. And then maximizing your financial resources. As I said, taking maybe a loan out of a 401k, or maybe liquidating a portion of my IRA or stuff like that. All of those decisions that you have will have consequences to your EFC positioning and things like that. And that's the thing that a lot of financial people don't understand as they go through this process. So what should be in your college funding strategies? One, understanding the 529, depending on where you live and what state you live in. Each of them have their own plans, and each of them have their own incentive programs. I know most of the people here are, I guess, from Pennsylvania. Pennsylvania is one of the 5 states that have what's called tax parity, where you get a tax break for using money or putting money into a 529 plan, and you can use any state's plan that you want. So that's a great advantage. Tax scholarships. So there are tax strategies that you can do by gifting or doing in-kind transfers, or maybe if you're self-employed, hiring your children on and lowering your tax bracket, things like that. The different ways you borrow the money. So the schools are really limited here. They can only tell you about the financial or the federal loan program, so the PLUS loans. But again, we talked about maybe taking a loan out of your 401k, or should I take a home equity versus that. The schools aren't legally allowed to talk about those options that you may face. If you're a small business owner, we talked about that being an advantage. Depending on where you are, you could have a tuition reimbursements program. There's some rules and regulations there you need to be aware of. Works similar to healthcare. What you give to one, you have to give to all. But again, it can really work to your advantage, and give them a tuition reimbursement program, which that becomes tax-free deductions for the business. And then retirement plans. If we have some younger family members using the Roth IRA, or even later on where you take the money from, can work to your advantage using the right retirement funds and how that's being decided. So let's talk about the educational savings plans. Again, there's 4 major ones out there that I can really identify with. The U.S. savings bonds, a lot of people probably have those. You need to be aware that those plans, those bonds have to be in the parent's name, and there's income limitations based on you file that for it to be tax-free. So again, there's a lot of promotions on that advantage for the savings bonds, but it's, again, the devil's in the detail. A lot of people don't understand that. The Coverdell programs, they're a really nice program. There's a $2,000 limit per year. The biggest advantage to the Coverdells, though, is that you can invest in any option you want. So that's the major advantage there, and that can be also used for high school. So that is an advantage. The 529 savings plans, again, a great option. The problem there is you have limited investment options. The plans are pretty defined on what your choices are, and you only get to make one financial change a year. Now, you can change plans and get another change, but within a tax year, you only get to make one adjustment per year. So that is another limiting issue that the 529s have. They are really, I'm not going to say stagnant, but you need to be very careful with the decisions you make around that. And then the Roth IRA is a great option, especially if you're a younger parent and you're trying to fund education. The Roth, again, wouldn't be counted. It's a retirement account in the EFC calculation. And if you need the money versus a traditional, if you pull the money out of a traditional for education, it doesn't get the 10% penalty, which is an advantage. But what happens is that will come in as income the following year, raising your EFC, where the Roth, if you take out the principal, which you've already paid, that withdrawal will not hurt you with your EFC calculation. So let's talk about the individual strategies by grade. For senior parents this year, you need to be really organized. If there's some things there, again, if you can build your EFC number, maybe there's some liquidations that you want to do before you fill that out for tax reasons. For tax reasons, again, this will work for all the students. The student can have up to $1,900 of unearned income before it starts going against you, and what's called the kiddie tax rule. So once they cross over $1,900 of unearned income, that could be capital gains, interest income, things like that, then it starts being taxed at the parent's rate. So this is where, if you have a gain, say you have a gain of, say, $3,000 on a mutual fund that's sitting out there, and now you want to move it out, you may want to cash out something now before now and the end of the year, and then cash the balance out on January 2nd, and that way over the 2 tax years it'll be all tax-free, versus if you cash it all out $1,100 of it would be taxed at the parent's rate. All right. I would, save your last pay stub. You're going to have to do estimates. As I said, the most common deadlines are February 1st, February 7th, and February 15th for the FAFSA form. You're going to need to put in an estimate, and again, use your last pay stubs, look at last year's taxes, and put the best estimate in as you can. I'd also try to get your taxes done as early as you can, and try to do an update. You don't need to, pay the taxes or submit your taxes, but you need to have very good estimates in by mid to late February. So I'd reach the deadlines. We always, for our clients, we put an estimate in January, and then try to get their best estimate once they have all their financial information, and a good 1040 done by mid-February, and update the forms, and then link it to the IRS system after that. Understand the position of the assets. So as I said, understanding that calculation, or should I move assets around? What schools is my child going to look at? All that kind of stuff. If you haven't made a contribution to the 529 plan, you have money put away. Again, the tax years and school years don't match up. If you're a Pennsylvania resident, Maryland, New York, there's advantages to putting contributions into those plans before the end of the year. You get a tax break. Make sure you tell your CPA or your tax advisor that you've made a contribution. It's something overlooked, that make sure you tell them that, so you'll get the PA income tax deduction. That follows the gift tax rules, so you can put up to $14,000 per child per year if the parent has taxable income. And then revisit all the schools. So look at, again, trying to focus on the outcome of the education, visit the career centers. If your schools that you visited were not in session, I would tell you, make sure you go visit those schools while the student body's there. That can have a significant impact. But they're the things you need to be doing as a senior, looking at your tax years, what things can you pull in, maybe from an income standpoint. But you've already, any decisions you've made throughout the year will impact your financial aid position going forward for the next 3 or 4. One thing that I forgot to mention when we talked about the federal methodology, I did say that the retirement accounts are not included on the federal side for financial aid. But what is included is contributions to your 401k, 403b in the years you're applying for financial aid, or add it back in for the FAFSA methodology, but not for your taxes, but for the FAFSA methodology, it's considered income. So just so you know that. For junior parents, we're in their best time to really look at these numbers, to review your financial aid position. As I said, think of the seniors this year. They were second semester juniors, first semester seniors, and that's the tax year that will be used. So you have until 12/31 to really see what your position looks like, and should you make some adjustments, maybe increase your retirement accounts this year, and then next year maybe not put as much in. Understanding how that EFC number is calculated is critical to understand your strategy, and then having an idea of what schools you're looking at. If your child, are looking at the, Penn States and stuff like that, then you may not qualify. It won't matter that much. But if you're looking at other schools, it may, have a big impact on where you're going to, qualify for more aid by making some adjustments. As I said, having assets in the child's name, once you know that position, it may be okay. If you know you're not going to qualify. Again, knowing those numbers is kind of critical. Review your 529 contribution. So I said, no different than the senior parents. You can make that contribution this year. If you have money, say you have, as an example, say you have $20,000 earmarked for education, and it's sitting somewhere that's, somewhat liquid. Well, you may want to consider splitting the year. So make the tax break here, do the 14 or 10 and 10. That way, both years you'll get the tax break in Pennsylvania. Where if you put it all in 20, you may not qualify, because depending on the parent's income and how it's set up will be an issue. For me, again, the SATs and ACT, that review program, or that starts really in January 1st for me. And then for me, it's a 2-year race, basically, between starting in January and then getting through that first year of college and their senior year, between the application process and leaving. It can be quite daunting, and it is a marathon, so just be aware of that. But for the junior parents, you really need to start looking into those prep courses and all that kind of stuff. And then start beginning the college, research and stuff like that. It's my recommendation that also they try to have testing completed by the summer. It's really, really important. I would think that becomes an important part, because if you have a senior parent, you know how hard it has been to do the essays and the applications, and then have the pressure to take your standardized testing. I think it can be disheartening. Um, for sophomores and below, so as you're hearing all this information, again, you have to do that EFC, determine what your position is going to be, and then project that at. Again, having assets in the child's name, same thing. You have another full year to make these adjustments if you don't have the time to do it this year. But again, starting January 1st, that's your last best tax year. And if you have multiple things where you want to spread gains over multiple years to get the tax-free benefit, that may be important. Begin the career and academic research there. It's really, really hard, but again, having some focus and direction as you go through this process is kind of important. I think an important part too, if I'm just through this process, and most of you may are probably facing this with your child, being the stupidest person on the face of the earth. I've gone through that process. My kids still think I have that problem. Having them have some peer review also is important. So if they, you're coming to the holiday season, you see a lot of family, being able to point out neighbors and family members and have them sit and talk to someone that's that 23, 25 that's gone through the college experience, both positive and negative, can have a significant impact on the child. I think that's an important part in the process that you also need to consider, and you can do that as early as junior year and point them out. So again, the children will often look at you and say, you're just a lecturer, tell me what I need to do. But if they get it from that, that niece or nephew or neighbor, down the street that has gone through the experience and maybe flunked out or has a lot of debt, and they hear those things, it makes your job, I think, a lot easier versus just telling them all the time, you're just really there to protect them. But having those influences from someone they know that's closer to the age is very, very important also. Okay. Okay. Other things I think you need to consider, this is as you go through the process, so internships and co-ops, again, this is where the Career Center comes into play. I think that's the biggest change that's happening in the college experience. If put yourself on the other side of the table, so having the child understand what they're doing, and what would an employer look like, or why would they hire you? I'm seeing where some of the programs have built in, so an example would be a teacher. They have it built into their academic process, where my youngest one has accounting, and so she had an internship program. I think that's an important part that you need to do that. How to do that is they have to either through their if they took AP courses, have the courses there waived because they passed the tests, or to take summer programs. I think that's an important part too, that may help them to free up a semester if they want to graduate in 4 years. To make the career decision as early as possible is better. So knowing by the end of freshman year kind of where they want to go, I think is very, very important. Understanding the career requirements. So as I said, now the PA rules for CPA changed when my daughter was in college, and that changed her whole planning that when she had to take courses and all that kind of stuff. The proper use of summer classes in the community colleges. So again, all of mine use those summer courses at the community colleges and at the regular colleges, and I think it's a great way to, one, get ahead for a variety of reasons, and also it's a lot cheaper. So here's, you take a summer course, those courses are typically half the price. That's an important part of your planning the right way. And then also, we didn't talk about this, but the cost of attendance has a few different parts. It has tuition, fees, room and board, okay, and then there's their book fees and also their personal living. All those expenses are included in what the school will call their cost of attendance. Having the child take on some of that responsibility, I think, is a great thing. My children had to pay for their books and had to pay for their personal living expenses, so they needed between $3,000 and $4,000 a year through a summer job and whatever to do that. So that's an important part that takes some pressure off of you. It gives them some financial responsibility. Also, one of my first clients, I thought it was a great idea. He told his son, he said, I think you're a 3.5 student. We're going to take the Stafford loans, and if you get a 3.5 and above, the loans are mine. If you don't get above that number, the loans are yours. And so he had the financial wherewithal to pay for the whole thing, but gave that child some type of incentive. I thought it was a great, great idea, and use the story all the time. So here's, just wrapping up here, one of the most, again, I think it's one of the most complicated things as you go through this process. Again, I'm a financial planner, but you have the EFC calculation, how that all positioning will work. Then you have what grants and scholarships could I qualify for? Then if I'm going to borrow the money, again, we didn't go through all this detail. And a lot of this is out there on the College of 40 website. So again, that's a great resource for you. But it is one of the most complicated financial decisions you'll probably make in your lifetime, and especially as a parent, and also one of the most emotional times that you will face also. Understanding how your EFC number is built and comes together, really, really important. Determining what's the best ESA, the best college savings plan. Should I use the 529 plan versus a Coverdale plan? Do I the savings bonds do I have? Can I do something there? Do I qualify for that type of tax-free growth? Again, many of you probably may not, but again, you need to look into those numbers. As I said earlier, using the family peers as a reference, I can't say enough about using that. I had a client, I teach a class at Delaware County Community College on college, and one of the students went home and was talking to their child about the investment, and child was working next to someone in one of the restaurants cleaning dishes, and came up and said, "Oh, where are you going to college?" And the other dishwasher said, "Oh, I went to this college," and all this stuff, and he couldn't believe the guy was, I think, 30 and washing dishes. Not to say that that's a bad career, but just talked about his experience. He partied and had a good time, and he's doing the same job this high school students doing. So again, it puts things in perspective for them. Having a focus on the outcome. So what do they look like at 25? Whose debt it's going to be? How much education am I going to need? One thing to look at the schools that you're considering also as you go through the process is, are the programs continuous, or do you need to reapply to a certain program? As an example, Temple, a lot of their programs are you have to reapply. Physical therapy or speech pathology after their sophomore year. Where other programs, as long as you maintain a certain GPA, you stay in that program. So be aware of those things, and they've worked so hard to get to where they want to go, and they have a bad semester or something that could really affect where they're going. And then the last thing is, a little plug, our website. We spent a lot of time there. There's close to 50 videos on the entire process. What's the EFC number, Stafford loans, all that kind of stuff. How does the loan forgiveness programs work? It's all out there for you to look at. And then again, we have the EFC calculator. So there's also another thing out there on our website under that roadmap. There's a chart that shows you what you should be doing at both in an academic and a financial standpoint. But please look at the website. I'm looking to see if there's any questions, and I've either put everyone to sleep or I've just overwhelmed you. Hopefully neither.
Thanks, Fred. I know it was a lot of great information. I mean, some of it I think you just scratched the surface, but it gives people an idea of what they need to look into. I mean, personally, I love the idea of that 4-year plan. I think it's so important, and you don't really hear a lot of people stressing to really, look at the total 4 years of what you're going to need and how things are going to change, come in and out during that time period. I think that's such a valuable tool.
Yeah, it really is important. It is a gigantic financial commitment that you need. But again, Debbie, I would also say the children have to buy in. There's so much pressure, and you have a senior this year. And we're just coming into where the early decision information is coming out. It's kind of interesting as I've gone through this process with my own senior parents. It's such an emotional time. You'll get through the holidays, and between holiday parties and things like that, and you'll see all those family members. By January, those kids are tired between the application process they just did, the SATs, and all that kind of pressure, and now the emotional part of, did I get in, did I not get in? Their life kind of flashes in front of them. They think it's the end of the world, but again, having a focus on the outcome of what they look like at 25, how much education, and it's not always perfect, so they just need to keep on going.
No, and I agree. And I'm going to actually stress one more thing you said, which actually really wasn't that much financially related, but the point about having them do as much of their testing early as possible, because it come time for the first semester of their senior year, there's just so much going on, trying to keep their grades up, because they're the first semester grades are going to be sent in, trying to do all these applications, and then actually the other thing is that a lot of them now are in leadership positions in the clubs or activities that they've been belonging to all these years. And then if you throw on top of that having to continue to study and prep for these tests, it just becomes a tremendous amount of work and pressure on these kids.
Yeah, you
So,
have to look at a few things there. I mean, again, each child's different. Like if they're in a spring sport or maybe like in the play, and it can be overwhelming, the pressure. But and I take this from Sigus, who was on your board, I guess. The way he says it, and this is the way I look at it and talk about it all the time, is one these SAT prep courses there's no silver bullet. It becomes a separate subject that they have to study and work at. So that's the first thing. Just don't think they're
yep,
taking an SAT prep course and they're going to get an extra 100 points or whatever it is. But if the way I usually recommend people is they start January 1st, and depends on how the holidays fall out, but in late March, April, the SATs and ACTs are offered a week apart, so it's no different than getting ready for a sporting event or a recital or whatever it is. They take those two tests. Again, this is for the junior parents. They take those two tests back to back. You ask them, one, don't put any schools on those free. You get 4 free on each of the schools
yep,
or each of the tests. Ask for speed testing or results, and then retake whichever test they feel they did better in and which one they felt more comfortable taking, and then you can retake that in June.
yep.
And that way, hopefully, they've gotten all their testing behind them. Again, based on their personal schedule. Some are doing some spring sports and spring activities. It comes hard, but and then you add in the proms and dances and all that stuff. It can be very difficult.
Yep. No, I agree. All good points. Okay, one last I'll throw out if anybody has any questions, feel free to type them in. If not, I mean, I hope you found this information valuable. Fred, I thought it was a great presentation, and you made a lot of the information easy to understand. Although there's definitely a lot here, and I really appreciate your efforts and your time and your ability to share all this with us. It was
Well,
great.
Deb, thank you for inviting me. And it was a pleasure being here.
Okay. Thanks, everybody. If you have any questions, you can email us separately, and hopefully we will be in touch and help you continue in this process. Everyone, take care.
Have a good night. Stay warm.